C-SPAN covering this day-long housing forum hosted by the Office of Thrift Supervision at the Treasury Department. And still to come at about 1 p.m. Eastern Time, we'll bring you the luncheon speech by Representative Barney Frank. He is the chairman of the House Financial Services Committee. Again, that around 1 p.m. Eastern, part of the luncheon at this event. And then later on at 2 Eastern, it's another panel, this one on mortgage-backed securities market. And later on at about 3 o'clock East Coast time, it's Neil Kashkari. He's the Treasury Department official overseeing the Financial Stability Plan. Again, our live coverage of this housing forum continuing through the afternoon here on C-SPAN. While we wait for Representative Frank at about 1 Eastern, a panel from this event from earlier today focusing on trends and the outlook in the housing and residential mortgage markets. It lasts about an hour.
It's now my pleasure to introduce Steve Leisman and our first panel. Steve is the senior economics reporter for CNBC. He's a staple on business television, appearing regularly on CNBC's Squawk Box, as well as a number of other programs. I told him this morning at breakfast that I see him at 7 o'clock in the morning on Squawk Box, and I see him at 7 o'clock in the evening on Larry Kudlow's program, and I wonder how many hours a day he's working. And I think he's working 15 to 18 hours a day. Steve previously served as a senior economics reporter for the Wall Street Journal. I also learned that Steve spent some time with the Sarasota Herald Tribune in Sarasota, Florida, from whence I came, and spent 12 years as a community bank CEO. Please join me in welcoming CNBC's Steve Leisman, who will moderate the first panel. Steve?
So I think we're just going to call our panelists up right away because there's an awful lot of stuff to get to, and Governor Corzine used a goodly amount of his time in terms of making his pitch here. And let me introduce my panel. Curtis Haig on my immediate right here, Chairman and CEO of the Home Federal Bank. And then there's Ron Hermance, Jr., Hudson City Savings Bank, President and CEO. John Taylor, to his right, National Community Reinvestment Coalition, and Mark Zandi from Moody'sEconomy.com. I want to just thank Governor Corzine for talking about this problem in sort of personal terms. We tend to, certainly in the financial community, discuss this in very abstract and financial terms like the foreclosure rate on option arms and stuff like that. And while Governor Corzine was talking, I was actually looking up at this picture here and thinking, you know, there's a kid in a house somewhere where a guy is going to come and serve foreclosure papers. And I think that's something we shouldn't lose sight of when we're talking about this. You know, or maybe a house across the street where, you know, that's empty because it's in the foreclosure process. And while Governor Corzine was talking, I actually counted the number of homes up there, and it's at 60 homes. And so that would mean that the 6 homes on this thing here, if some of the communities he was talking about, if 10% were in foreclosure. So I just think, you know, and I'm probably guilty of it as anybody else thinking about this in abstract terms, but I think the problem is relatively serious. And in fact, just to make this as bleak as it could possibly be, there's only one person to start with, and that's Mark Zandi. Mark, give us the unvarnished housing outlook as you see it.
You know, I didn't realize I had that reputation, Steve. Yeah.
Well, just telling it like it is.
Yeah. Well, I'll give you my outlook quickly in terms of housing. I think home sales are pretty close to bottom next few months, in part because of the surge in distress sales. Foreclosure sales, short sales are about, at least according to the realtors, about 40% of the market. So I think we're close to the bottom. Of course, the bad job market means we'll have another several months of weak sales, but I think we're pretty close there. In terms of housing construction, housing starts, I think the bottom is this summer, which means it's a pretty low bottom. We are already at a post-World War II low with respect to construction, single-family, multifamily starts, and I think we'll see even lower levels through the first half of 2009, in large part because builders are having trouble getting credit and don't have the capital to build, and demand obviously is weak. In terms of house prices, I think the bottom is September 15th. September 15th.
One or the one that just passed.
You want to know what year?
Yeah, what year?
Yeah.
Didn't you tell me as a forecaster, give him a number or give him a date, but don't give him both?
Right. Well, I actually, and this will sound optimistic, I think it's September 15th, 2009. I think that'll be the bottom. Not that prices will come back quickly. I think it'll be another year after that before we see any kind of price growth, so end of 2010, early 11. But I do think by late 2009, housing affordability will have been restored, the job market will be stabilizing, and prices will stop declining.
John Taylor, do we worry now about, given the numbers we had in unemployment on Friday, another wave of a downturn in the housing market? It strikes me that a lot of what's happened in the housing market has happened almost in the absence of dire economic news.
Right. I actually think that it's more bleak than Mr. Bleak is his suggestion. I hope he's right that we hit the bottom by September of this year. I think we have a new wave of, we all know, we have a new wave, if you look at the data, of now the option arms, which weren't counted as subprime because they appeared, at least statistically, to be prime loans. That wave of problematic loans in which people are going to be underwater is hitting us now and will continue to hit us through 2010 and even to 2011. And you've had some statistics on this, as has Credit Suisse. And I don't see the numbers that support a lessening of the foreclosure filings, because they continue to break records, the filings anyway. And I don't see a solution that's currently on the table that addresses the things that Governor Corzine just spoke to that's going to really slow that down. If we continue to do this top-down approach, I think it's going to contribute to increased unemployment and weakening of other segments of the economy as the constriction in lending across the board with banks continues, and then I think more industries are going to be challenged to be able to be successful in that environment. So I think we've got to, unless there's a massive response immediately from the new administration, which really addresses stopping the bleeding on the local level and gets ahead of these foreclosures that have hit us now and that are coming, I don't really see the optimism that Mr. Bleak is bringing to the table.
Yeah, somebody was joking to me earlier that the new phrase is, it's going to get bad before it gets worse. Ron, you're where the rubber meets the road here. Tell us what your book looks like and what your outlook is for your book.
Well, I should first give everyone our frame of reference, Steve, because it's a little different than what you've heard today. Hudson City is a portfolio lender. That's all we do is mortgages. We don't sell to the GSEs. We never have. We're $52 billion in size, so we're not small. We're one of the I guess we're 20th largest in terms of market cap in the United States financials, and we didn't take TARP. So all of those things. I guess maybe one more thing is we have 9% tangible capital, and we've made $7 billion worth of home mortgages this year. So my frame of reference is a little different because we serve all of our communities, cities and rural areas alike, through a variety of instruments. And I'd have to tell you, Steve, that if you came into our shop, you'd wonder, because we have 4 foreclosures going in the state of New Jersey. That's it. And all of those foreclosures have equity in them. But I think when the story gets told eventually out there, and this is something I haven't heard at all, but when you hear from a lender, you'll understand this, is when we do go to foreclosure after we've exhausted all means of dealing with the mortgagor. And you know, Governor Corzine has some great ideas here, but one of the things is communication sometimes stops, by the way. You have to sit on a collection desk once in your life to understand what really goes on. Because quite candidly, after 30 days delinquency, we're in touch with people. People that need to have a workout get a workout. Somebody said to me, are you doing modifications? And I said, we've been doing modifications for as long as I can remember, and I've been there 20 years. When you have a problem, people deal with the problems. The hardest thing from our standpoint is to get the mortgagor sometimes to continue the communication. There are some great community groups out there who are trying to give terrific advice and stop the mortgagor from being somewhat paralyzed about his situation. And oftentimes they can't get through to these individuals. If I told you today that of those foreclosures, 2 of them are below $25,000 in balances, you'd be stunned. But when this story gets written, you're going to find that the debt behind those is large. And so it isn't, in many cases, I mean, we'll talk about this as the panel goes on, it isn't in many cases the first mortgage that has paralyzed that consumer. It's whatever debt they've piled on behind them.
Ron, I'm going to stop you there because Sheila Baer's coming at 10:45. I'm guessing you want to get out of here and out of Washington before Sheila shows up and makes you take 8 banks on to your books as a takeover.
You know, it may be so, not exactly so, but you know, we have, with all of the government agencies, registered an interest in other organizations, but many times what you're going to find, Steve, when you look at some of these banks is they're beyond solution, unfortunately. They've thrown everything against the wall long ago before you came in to do due diligence. There isn't much left for you to recover. I was extremely impressed, and it's the first time I've heard it in a long time, with Governor Corzine's comment about the Homeowners Loan Corporation. In 1934, that was originated at the same time as the Federal Home Loan Banks were originated. It went out of business eventually without any losses. That's where the United States should focus.
Okay, let's come back to that. Curtis Haig, you're from your banks in South Dakota, and you have a similar story to Ron. We found the 2 best bankers in the country right here, which I think is great because we need some better banking in this country. So how did you escape what happened to the rest of the banking, to many in the banking world right now?
With that accolade, I'm going to stop right there while I'm ahead. We've been we're in South Dakota. We're a $1.1 billion savings bank that has changed its balance sheet to look much like a commercial bank. We do home lending, but we also do agricultural lending and business lending, and we have a trust and investment department as well. So our view is a Main Street agricultural Midwestern background view. Like Ron, we don't have a serious foreclosure problem. Last year we foreclosed on 6 homes. We don't have a delinquency problem this year that has indicated any trend upward, although we're getting some news in the last month or so that indicates there's now some stress on some of the Main Street businesses in South Dakota. I would echo what Ron said about the nature of foreclosure and consumer behavior and relationship with banks. Our bank, too, has a long history of working with the troubled borrowers, modifying loans when it's appropriate, when there's a reasonable hope that a modification can actually help the borrower stay in the home and recover. And we've had many success stories to give support to that kind of philosophy. So this notion that seems to be part of this crisis description, that the bankers are on one side locked in a duel to take away homes carelessly and callously, it just doesn't have foundation, at least from my experience. The solutions that are being proposed then are equally disturbing to me. When you think about all the pieces of the puzzle that are moving here, there is not one solution in my mind that's going to solve all the problems. And so when we talk about let's save people in their homes and preserve home ownership, we'd all applaud that. But we have to understand from what perception of that we come from, and there's different perceptions, there's different realities. So we have to be very careful. I would also agree with Governor Corzine that we need the Home Ownership Corporation back, and I think that's a good foundation for us to start in terms of how to provide funding and how to provide a means to help people who can truly stay in their homes, work out their home ownership. I think there's another problem that is starting to scare me, and that is was alluded to also in the comments earlier. To this point, it has essentially been a market conversation about credit markets weakening. The assumption has been that income streams in family households have been there and have been able to support some level of home ownership. the job losses we've been reading about here in the last 3 to 4 months and are still coming forward change that model. Home ownership and foreclosure forbearance is not going to keep people in home if there's no income there. And so we really have to pay attention to job preservation and job creation far more, in my opinion, than we do in simply saving people and trying to keep them in their homes. And I'm all for people staying in their homes. But without income, that's impossible.
Mark Zandi, it sounds like what's being said right here is that, first of all, there is no single solution, obviously. But in terms of the broad tracks we need to be on, a stimulus package to keep people employed is one huge aspect to the problem, whereas another aspect is some sort of broad program for mortgage modification or otherwise taking the assets off of the books of the banking system. Maybe give us some background on the HOLC, which I remember Alan Blinder, the former Federal Reserve Vice Chairman, wrote about a year and a half ago, was it, or 2 years ago? And the idea was kind of dismissed.
Yeah, about a year ago, an op-ed piece, I think in the New York Times, he proposed it. You know, essentially the idea is that a government-funded organization, agency would go out and buy distressed mortgages, modify the mortgages to help people stay in their homes. And then at some point in the future, presumably when the market improves, sell those mortgages. And the Hulk, I believe, made a profit at the end of the day when the market turned. I'll just mention two potential problems, you know, with the idea. First is for the government to buy the mortgages, there has to be a price for the mortgage, and that's a pretty sticky issue at the moment. And you know, the government could find a price, but one of the arguments or complaints about any plan is that you're bailing out the mortgage owners if you give them too high a price. That's one of the criticisms being leveled at the Sheila Bair plan, for example, at this point in time. The second thing... You
mean the investor, the holder of the mortgage?
The mortgage owner, yeah, right. The owner of the mortgage. And that, just as a quick tangent, that's one of the disappointments with the switch in emphasis of TARP. It originally began as an effort to establish some get price discovery in the mortgage market, and that's been abandoned, and I think that was a significant mistake, and hopefully we'll get back on track with that, because we need a price so that we can buy a mortgage. Second issue is it's going to cost a lot of money, I think, in this go-around to the taxpayer, because so many of these homeowners are so far underwater, and I think the recidivism rate on any modification that involves interest rates or term extension will be extraordinarily high if it doesn't include some mortgage write-down. And you need to have a big mortgage write-down to make this worthwhile for people to make it through, at least for a considerable period of time. And so I think this go-around, the Hulk variation that we would get would cost money, lots of money. Not $10 billion, but probably, you know, $100 billion if you really wanted to help a couple, 3 million homeowners. So that's something we need to consider.
We turn to go ahead, John. I'm interested in the following. TARP, Hulk sounds like TARP in, you know, different way, but TARP, the initial idea got hung up on the pricing mechanism. I was confused that, hey, this is America. If any country can set a price on something, we can figure out how to set a price. And I was just amazed that it sort of failed for that reason. Is that such a critical, sort of an Achilles heel to the program, that they can't come up with some form of a price that benefits both sides?
It certainly is to the investors, because the price that they want is full market value.
But they're sitting on something that's been marked down so far.
Now, see, you're using logic and reason, okay. And that just doesn't fit in this conversation. Let me give you the facts. Green Tree Financial sued Countrywide after they were told by 11 attorney generals to do certain things, and one of the things they did was to do modifications so they can prevent massive foreclosures. Now, we can sit here and give the statistics of, you know, how much an investor loses by going through foreclosure than by going through some meaningful modification. But the problem is that, you know, not only are they not willing, and you know, one of the reasons, I hope Alliance, God bless them, but, you know, one of the challenges they have is the challenge that that Governor Corsine identified, others have identified repeatedly, is the willingness of the investment community to voluntarily work with their servicing banks to allow for meaningful modifications. Well, it just isn't working on any scale that's going to allow us to end this crisis in a way or create the floor for the crisis so we can turn this corner. And whether it's the Incredible Hulk or whether it's, you know, we proposed 12 months ago, Help Now, which is essentially the same thing. And Mark, you know about this, what NCRC proposed. But what it all boils down to, regardless of the model you use, is the government has to get control of those assets. And either we're going to pass bankruptcy reform in the next administration, or we're going to, you know, if we wanted to right now, Secretary Paulson and President Bush could move quickly by using the eminent domain statute. There is a public purpose in this. There's a public interest which allows them to go in and acquire assets. They do it all the time. Acquire these loans, define these loans and acquire them, and then pay fair market value. What's fair market value for something that nobody wants to buy? Well, I think it gets at your problem, Mark, which is we can have these loans reduced to a scale, and we can pay the fair market value that allows the banks and FHA and the government and others to be able to modify these things. You've given them something to work with by acquiring these mortgages away from Wall Street at a level that can now be refinanced. In fact, a lot of it, we hope, can actually be done without any government involvement. If the price is right, if you get the modification down to a level, Steve, that where, you know, it matches the borrower's ability to pay, you just go out to the private market and you set some parameters that have to do with interest rates and terms and conditions that are competitive and non-predatory, and you establish that, and you say...
This is why, John, this is why I love my job. I mean, who else will be able to go on television and say the government is using eminent domain to purchase mortgage-backed securities? But I don't get, Ron, among other things that I don't get, a modified loan increases the net present value of the cash flow streams. What's wrong with these people?
Well, I'm going to go back to something that you just asked John, and John commented on, and part of this I agree with. Let's go back to the reason for which TARP was created. I think there was a lot of optimism, certainly by me, that that money was actually going to take securities off balance sheets. Now, you know, people have said, well, you know, at what price? You know, I was going on TV, on Fox TV one day, when I noticed at running below that Wilbur Ross said, after the TARP program, that he was going to form a private equity fund to also bid on these assets. And my belief is, truthfully, that if TARP were allowed to go at those assets, and let's not forget it, that even though they're on the books of Citibank and others, they don't want them on their books. They want to get rid of them. So the idea behind it is that, yes, they've marked them down to a certain number, but now let's get a bid out there. And if the government made that bid through TARP, I'm telling you, private equity be in there bidding as well.
Mark Zandi, $1 of liquidity in a market without liquidity can have infinite effect.
Yeah, that's right. I mean, you know, I think going back to the mechanism, the reverse, I think they got hung up on the reverse auction idea. I mean, I just think that got a little bit too complicated, and things were moving too quickly. But I think now we need to go back and revisit things like reverse auctions. And even if the government establishes a price and it's the wrong price, to your point, it'll quickly find the right price, because then you will have Wilbur Ross and you will have other groups, because they'll say, oh, that's too high, and another group will say, well, that's too low, and then you've got a market and a price.
Absolutely.
Curtis, you want to comment on this idea? First of all, I've not quite understood. Fed Chairman Ben Bernanke keeps talking about the need for system-wide modifications. I've never quite understood how you do a systematic modification of thousands of separate individual cases.
And I would have to agree with you. I don't understand how you do that either. I'm very nervous about that notion. As I said earlier, I think you have to understand that in this environment there is a whole plethora of characteristics that drive foreclosures, and to say there's one type of foreclosure situation and all we have to do is fund it, buy it out, and the problem goes away, I think is a huge overstatement. And I don't know that many people are really saying that. I did pick up on Governor Corzine's comment that the solution is going to be one loan, one customer at a time. I do believe that. And so part of the way we craft the solution, in my mind, ought to be to recognize the Main Street effect of local community banks and understand that we are the people who are face-to-face with those customers and probably have the best insight on how to evaluate. Having that opportunity, then we do need mechanisms to work with, and a home ownership loan corporation could be one of those mechanisms where if we had authority to refer or recommend or place loans there, that could take some of the risk out of the system.
Let me stop you there. Explain that to us. How, from an operational standpoint, that would work for your bank?
Well, because we don't have a large foreclosure, I can't tell you from experience with dealing with the problem, but theoretically it would allow you to take an instrument then that has been able to be negotiated to some level, and if it's a level where that individual bank can't afford to or doesn't have the appetite to hold it, you have another method to refer it to, and whether that goes automatic or goes with further negotiation, I don't know enough about the details to say that today, but I think this does have to be done one at a time, or we're really going to set ourselves up for a huge failure, and I don't think it'll ever get solved.
Steve, I want to say I think it can be done wholesale. I think that if the government were to, you know, all these loans, and obviously there's loans that have been broken up and that have different ratings, and you know they're split up. It's not like a single loan sitting in one security. It might be multiple portions of that security, but they all have the same loan number. And if the government were to identify those loans and pull all parts of that loan and all the troubled loans and identify those loans by saying loans made between this period, 2002 and June of 2008, and that have these characteristics, and define them as subprime as well as some of these all-day payment option arms, really identify this pool of loans. Well, they're already being serviced by, the top 25 servicing banks probably cover 80% of all those loans. So already the people who are supposed to be collecting the payments on these loans and sending them to the investors, that mechanism is in place. And so by pulling these loans down and saying to those institutions, you can, we've reduced this loan by the amount that we've now acquired them through eminent domain. If you want to do it right away, bankruptcy, that will bring everybody to the table. It's another solution. I don't think as swift. But you can then say to these services, okay, we've reduced this loan this amount. We want you to go to the homeowner and say, and modify this loan according to these characteristics. And if that doesn't work, we will do an additional thing, either a government equity or some other, contribution that's recovered at some point. And it can be done because the mechanism's in place to really do this, but the spirit hasn't been there. It's not.
Kurt, you're shaking your head.
You talk about reverse auction. It's not that it didn't work. They didn't try it, right? They couldn't.
Kurt, what's wrong with what John's saying?
Well, this is not one loan. It's not one loan number. It's not one situation. It is a pool of loans that are individual people, and those pools are spread over a geographic area. They're not all from one community or one bank, and so. The notion that it's got a standard characteristic you can deal with, I think, is a broad brush, and I respect your position, John, but I really think from the experience of dealing with customers one-on-one, I just can't see how that could work with any real effectiveness. Great inefficiencies in doing it that way, and you're going to solve some of the problem, but I think you're going to create a lot more problems. So I really believe that you have to get down to one-on-one, and I agree there. Today, one of the things that have changed in the world from the 30s that we can't lose sight of is today we do have a secondary market that has been part of this system, and in the 30s we didn't. And so in the 30s you were dealing with individual banks who were basically had portfolios of one-on-one. We don't have that today. We have pooled the servicing into third-party relationships, so the problem is more complex. But nevertheless, it still has to be one-on-one.
And the servicers collect fee, and then all of a sudden when it's time to actually do some work, and go ahead, they complain about the cost of servicing the loan. Well,
I'd speak up on that behalf. We're a servicer of South Dakota Housing Loans. That's our state agency to assist first-time home buyers. We service about 75% of that portfolio, which is just short of $1 billion. And we work hard for that money, and we don't stop what we're doing because we're getting a fee or not. Our goal is to keep those people in their homes as well. I would just want you to know, characteristically, we sent out a higher than normal number of demand letters in the month of September for those first-time home buyers. I was talking to the person in our office who handles that, and I said, can you give me a little background? And She said, well, yeah, I've been calling them and really trying to follow up. And she said, what I'm finding is most of those people are embarrassed because they haven't been able to make that payment. And they had not talked to us. We had invited them to come in and talk. They had not come in and talked. So the demand letter said, you must come in and talk now or you're going to lose your home. And that was enough of a jolt to bring most of those people in. And she said, once we had that conversation, we figured out ways to work out the problem. And you know, a fraction of those people really had trouble that they couldn't deal with. But most of them were simply embarrassed by the situation and didn't want to talk about it. So this notion that everybody's in the polarity of for, against, on or off, able or willing, is just an overstatement of the problem.
Let me ask Ron. Last week it was revealed that the Treasury is out there with some sort of plan to go out and lower mortgage rates to 4.5%. And this comes a week after. Boy, it's hard to put the timing things. It was like, when did we bail out Citibank? Was that like a year ago? Or, and it was like 5 years ago we put Fannie Mae and Freddie Mac in a conservatorship? That's what it feels like. Anyway, the week earlier, the Fed said it was going to go buy some $500 billion of MBS and $100 billion of the debentures of the GSEs. So is that going to help? Is that part of the solution here? Do you support that?
Well, you know what, Steve, go back a little further in the spring, and we had this conversation earlier. They raised the GSE limits in certain demographic areas up into the 700,000 range. And then after that, I think it was, they added dollars to the FHA to buy back subprime and option arms, which I think is a great idea. And then we went to TARP, and we took the two GSEs into conservatorship, and then we bought $500 billion worth of GSE and Federal Home Loan Bank paper, and now we're trying this. I think, you know, I'm in the industry and I'm confused. I can't imagine what the public feels about all these programs that they're seeing glide by, and how much total dollars we're all talking about here. And while, you know, I too want to solve this problem, I guess we're all of the generation, Steve, that wants immediate gratification. We want this problem to go away. And I think, as Mark would tell you, recessions have a lifespan. And we're trying to force feed this recession backwards a little bit. Some of this is going to have to happen, unfortunately. It's going to have to take time to solve this problem. I think some of the things we're talking about are very, very intelligent. But to do 4.5% mortgages when you're force-feeding a rate down in the marketplace doesn't make any sense either. Who is going to buy it? The GSEs. And what are the GSEs doing right now? They're inundated. They are inundated. And they're under scrutiny starting today or tomorrow at the House subcommittee about what are they actually going to look like, what's their function, should they be public, should they be private, where should they be. The FHA, which I said is a great spot for redoing subprime and for looking at option arms, is inundated. You've got every agency who should help you, trying to help you, to the best of their ability. So lowering rates doesn't do this at all. And if you think that's stimulating buying in the economy, think of this. Back in the early 90s, I remember very vividly when we had the last recession that hit my neck of the woods, which was the Wall Street recession, where if you weren't unemployed, you knew somebody that was, so you didn't make a major purchase. And that's what's going on right now. We didn't talk about attitude, but attitude out there is, I've got no confidence, and I'm not sure the market is where it's going to be 6 months from now, housing-wise. So am I going to go buy a house? Do I have job stability? When you start to see people losing their jobs, you lose confidence.
But Mark Zandi, if you were to look at, from a different way, the spread of the mortgage rate to the 10-year, you could make an argument for, in a even halfway normal market, a 4% mortgage rate.
Yeah. Yeah, and I think this is a reasonably good idea. You know, it's not the answer. You're right. I mean, if you don't have a job, it doesn't matter what the mortgage rate is, or if you're scared of losing your job, it doesn't matter. But, you know, 4.5% rate is, I think, helpful. And it is, you're right, Steve, it makes the mortgage spread more consistent with historical norm. If you take a 30-year fix, compare it to a 10-year Treasury yield, the average spread is 175 basis points. The 10-year yield is, what, 250? So Yeah, I mean, it's all they're trying to do is get a more normal spread in the marketplace because they haven't been able to do it in any other fashion. You know, they thought they would get it when they took Fannie and Freddie into conservatorship. They thought they'd get it when they said they'd buy their debt and the mortgage-backed securities, and they didn't. And so this is their way of trying to do it. So I think it's very helpful. But there are limitations to it, in addition to the fact that it's not going to override the weight created by a bad job market. And that is, it does not address the foreclosure issue directly at all. This is not an answer to that. And it's being sold to some degree as an answer to the foreclosure problem, and it is not. It is not.
Well, I think we have to think again about the whole process, and I don't agree with the general consensus that the mortgage is the source of the problem. I think it's a symptom of the problem, and it's a very real symptom. But the real source of the problem is that American consumers have reached too far, leveraged too highly in terms of the size and cost of housing, and we as a public policy have embraced the notion that we want everyone to own a home, and the bigger the better. And I'm not critical of that. I think it's a wonderful dream to have, but one of the problems in my view that we're seeing today is that people have simply gone too far. So to solve the problem, you have to ask the question, what are those constraints that ought to be in place to help monitor that? And I think the old-fashioned underwriting standards like down payment is a good leveler for that.
What was that word?
Down payment, credit capacity, which these are the things that were waived in this fury to get more people into home ownership in the last couple, 3 years, and the no document type loans and all of those things were stretches to exceed the capacity that the consumer had to own homes, and we're having to pay the price for that now. So when we think about solving the problem, let's make sure we think about solving the problem, not solving the symptom. Clearly, we have to solve the symptom because it is truly large and it's truly going to affect our capacity to eventually resolve the problem.
Steve,
I mean, the fact is, go ahead, John.
I think his conclusion is correct. I think where he began is not, with all due respect to Curtis. This malfeasant lending that occurs, in the words of Alan Greenspan, infectious greed and malfeasance is how he termed this period of lending, was not about increasing new home ownership. There was actually less than 10% of the mortgages that were made went to people who were going to end up as first-time home buyers. Most of it went to people who decided they could go into bigger homes or to refinance. And frankly, what used to happen in this industry, and I bet it still happens in South Dakota, is that, and in New Jersey with these two lenders, is when a borrower sits in front of a lender, they really look at this person, look at the characteristics and the aspects of their income and other considerations, and really determine, am I ever going to see this money again? I mean, it seems crazy to have to say that because that just used to be the norm in the industry across the board. That's what changed. When it became a fee-based thing in which brokers and loan officers, the very fee that they got, actually they got higher fees if they talked into higher loans and to higher cost loans. They were rewarded for that. When they no longer had portfolio lending, and particularly when the very institutions that were bailing out on Wall Street created a pipeline that said, bring us anything. We have the rating agencies with us. They'll slap AAA, AA, single A things. We work with them. We pay them.
That's not me, by the way.
Of course not. You're on the research side, right? Right. But my point is that what really happened was the industry changed in a way that it really was very different than the kind of responsible financial services sector that this country was used to throughout its history. And it changed rapidly. And at least we missed this understanding about what occurs now. There is a direct causal connection, a direct correlation between safety and soundness and how you protect consumer interests at all levels. We now know that, right? Because this was abusive lending practices without much regulation or oversight that resulted in these high-cost loans disproportionately to low and moderate income people, although the majority is still in middle income.
John, I think there's a squawk box segment coming between you and Kurt, so go ahead, Kurt.
Well, I agree.
Daily disagreement.
No, I don't disagree at all. I agree with John in terms of the practices that were put in place. I would want to position that, though, in that the mortgage origination industry is two components, two segments. One is the commercial banking segment, the savings and loan segment that's regulated.
Yeah.
And then there is a mortgage banking segment that's not regulated.
Yeah.
And the invitation to new products and some of the things that you talked about came from Wall Street and from investment bankers who wanted to fill the pool of capital that was looking for a place to go and abandon some of the time-tested underwriting standards that were part of the regulated industry. So I agree with you, the practices occurred, but understand the environment in which they occurred, and if we're going to solve the problem, maybe we have to look at that environment and see what regulation or how we make a more standard regulatory approach to the whole industry rather than a bifurcated approach.
And Steve, let me finish by also piggybacking and saying, you know, all of this would have stopped if there weren't an aftermarket for it. But let's not forget, Wall Street, if you'll remember, bought an awful lot of these subprime originators. Merrill Lynch bought the subprime originator from National City. People bought because they wanted control of this product. They wanted to originate more. They wanted to invent new securities that it turns out nobody understood and still nobody knows how to price. And yet, I'm not going to leave the GSEs out of this either, because they bought a ton of subprime. And we're buying it after everybody knew it was subprime. Now, so there was an end user for this security. And what we found out in the liquidity side of this, which is what stopped first, it wasn't that we found subprime, liquidity stopped first. What I mean by that is people said, all right, the delinquency ratio in these CDOs that I've got, or in this mortgage security that I've got, far outweigh what my risk people told me I was going to get. And I'm not buying any more of that stuff. Bingo. And the GSEs got that picture a little later than Wall Street, but by that time, everybody owned them. And all of a sudden, nobody knew how to price them. And
Ron, I don't want to spend that much time on the past, which is
but I think,
fabulous.
Steve, the only reason I'm bringing it up is
I
let's
wanna
not
protect it,
recreate that mistake going
good
forward.
idea. Okay. I do want to ask you a question. I want to open up to the audience. We're going to have a little bit of time for that, but I want to just read you an email I got from a banker friend of mine who writes me all the time to complain about the government. And I just thought with regulators in the room it would be interesting. Banks should have made $400K in Q3, but only made $60K, thanks to one, FDIC requirement to put in a ton more to loss reserves, parentheses, we haven't had any losses in 5 years. 2, higher FDIC insurance premium. 3, 425 basis point reduction in revenue on 30% of loans. Can't cut rates on savings account fast enough to keep up with the Fed. He goes on to say how he can't really pay his bank staff a bonus this year, even though they grew the assets, because it's all going out for the government. Ron, do you want to comment? I mean, it sounds to me like things the government is doing are pro-cyclical. They're making things worse for the banks when they should be making it better.
Well, I'd chime in on one thing that your friend has said, and that is the FDIC assessment fees going forward. Let's think about that. In other words, the fund itself is supposed to maintain a regulatory minimum of 1.15% of deposits nationwide. And yes, they've been hit by IndyMac and they've been hit by a bunch of others. So out for proposal currently is really a doubling of the FDIC fee. Now let's think about who they're doubling the fee to. What's really happened is all of the community banks have had a flight to safety. In other words, if you're on Main Street in Bayonne, New Jersey, you suddenly are getting more deposits than you ever dreamed of because people don't want to put it in some of the major money center banks that have had problems. So you're gleeful, but you're trying to figure out what to do with the money, because you can only make loans so fast. And I would say to you that most of the community banks are not the folks that John's talking about. They're the people that are making the loans out there today. So now they're getting the money in, and they're trying to reinvest, and they're trying to pay their depositors a good rate, but they're saying, wait a second now, come January 1, you're going to double my fee? And then those of you that are using the Federal Home Loan Bank, by the way, which is, somebody said to me, well, why would you do that? Well, Federal Home Loan Bank provides advances that are of a term nature, and if you're a mortgage lender like I am, you can't lend long-term money on short-term deposits. I mean, it's fundamental 101. So you're borrowing from the Federal Home Loan Bank. But those of you that do borrow from the Federal Home Loan Bank, the proposal says that come the middle of the year, you're going to pay extra for your non-core deposits, which are your borrowings. So on the battlefield, there are those of us that are still standing, but somebody's trying to take a gun to us. You know, and I don't know that, I think that's the law of unintended consequences, if you will. I, too, want to see that fund back up to 115. You know, everybody's applying for TARP. Maybe we should apply for TARP for that fund, or look for a government guarantee.
Borrow from the government so you can pay the government.
Well, or, you know, it's only for those that fail. And, you know, there is precedence, because in the RTC days, they did up all of our premiums. But let's think about the conditions now versus the conditions then. The guys that were left then were big. The guys that are left now are small. And so you're penalizing Main Street, and they're going to suddenly turn around and hurt the consumer, because what they're going to say is, I can't pay you the deposit rates that you had before because my premium just went up for these deposits.
So regulators, as they try to help, need to be really careful to do no harm first, I think.
Exactly.
Mark, real quick.
Yeah, I was just going to say to your friend, we don't know what the counterfactual is. I mean, if government hadn't stepped in, he probably lost a lot more money. I think the banking system would have seized, and he'd had a tremendous amount of difficulty. So I'm not sure. Now, clearly, policymakers have made their fair share of mistakes, but without aggressive government intervention, I think we'd be in a much worse place.
Except I'd say this is a banker that probably knows it's his top 10 borrowers by first name.
I think all bankers, no matter who they are, would have been affected.
Yeah, no, it's probably too. Kurt, real quick.
Well, I just want to throw into the mix some of the other procedural things that have been injected into the mortgage lending process with good intention, but they're going to be a drag on recovery. Just last week, we were informed that now for people who are self-employed, you have to provide us your last year's tax return, which is normal. But we now have to go to IRS, have the customer sign the release, and go to IRS and get a copy of that form to match up to make sure that there's no fraud involved. I don't know if IRS is staffed up to handle the millions of inquiries that are going to come from that, and what that's going to do is slow down the whole process of closing a loan. We also were told that we now have to have the actual Social Security card present, and if we don't, the customer has to sign a release when we release, and we have to call Social Security Administration to get a copy of that. I don't know if Social Security is staffed up to handle the many millions of calls that are going to come from that. So those are things that come with well-intention and good foundation, but I'm wondering who thinks about the practical application and what the timing, the access is going to actually be. We've also tightened appraisal standards, rightfully so, in some arguments. But now if the market is starting to recover, remember that appraisal is based on historical. So you now have a historical fact that falling house prices, if the market starts to recover and prices rise, where does the appraiser get a foundation to actually sign off on a house that's selling today for more than a house might have sold for 30 days ago? My son is in the home lending business in Arizona and cited a case with his company. They had a foreclosed property that they were able to find a buyer and a seller. Each buyer and the buyer and the seller each agreed on a $150,000 price. They put it into the appraisal process. The appraiser came back and said, I'm only going to appraise it for $135,000. With that kind of position, they can't sell that loan to any secondary market provider. They don't have the means to portfolio it, so they're in a standoff. So as we think about what's the role of appraising and what's the role of establishing value, how do we establish value in an inclining market from a declining market? Historically, we have had inclining markets rising. We have very rarely had falling markets now starting to re-rise. So we do need to rethink some of the processes and how the linkage occurs in terms of both protecting safety and soundness and yet recognizing market change.
Did you say 2 buyers wanted to pay $150,000 for the house, and the price would only be $135,000? If there's questions, I don't know if there's a microphone around. Sharon, are we going to do there's the microphone over there. Bert, over here, if we keep our comments short and questions short, that'd be great. Right there.
Bert Ely. Steve, thank you. Going back to your picture, let's say there are 4 or 5 or 6 houses in foreclosure. The rest of those houses are not. Many of them don't even have a mortgage. How do people who don't get assistance from the government feel when their neighbor, who they feel may have overbought, overextended, gets assistance? I would suggest to you that that's a very serious political problem that is not being discussed enough. I would be interested in how the panel members believe policymakers should try to somehow comfort those who don't get assistance because they feel that they were a responsible home buyer and borrower?
I know the answer to that question. The answer to that question, it is exactly proportional to the length of the grass in the foreclosed home.
Yeah, good question, Bill. And I think we begin by not paraphrasing it as people who were greedy or who bit off more than they can chew and whatever, but really people understand that for most borrowers and those in foreclosure are still working, their income hasn't changed. They're people who believed when the loan officer or the broker told them that they could afford this loan and that they'd be able to refinance or there'd be the equity to grow, whatever they was sold, whatever bill of goods they sold. So I think part of it is first stop blaming the people. Nobody goes into a home expecting they're going to, desiring to be foreclosed on. But the biggest point I think we need to say to homeowners who have nothing to do with the subprime market, are paying diligently on their homes and so on, is it is in their interest to stop the foreclosures and to help their neighbors who don't have the same loans that they have. Because your property values, you the person with the prime loan who pays every month, your property value is going to continue to decrease as long as these foreclosures continue. And it's in your financial interest to stop this bleeding for borrowers who are still working and can afford to pay on a prime or a near prime mortgage that matches their ability to pay. It's in the interest of everybody in that neighborhood to support that idea.
Mark?
Well, and I think the broader point is that the foreclosures are at the heart of the nation's economic problems, that it's the foreclosures that lead to the mortgage losses, that are leading to the financial system problems, that are leading to the broader economy's problems. And I think that link is increasingly clear in the minds of most Americans, whether they have a troubled mortgage, they are paying on their mortgage, or they don't have a mortgage. They know that those people who are getting foreclosed on are affecting them because it's affecting their jobs. And I think if we can make that very clear in their minds, then it works politically.
But I'm just saying, as long as we continue, and Kudlow, for example, continues to say, these darn poor people, they bit off more than they can chew, it's all their fault and so on, it's hard for people to begin to show any type of sympathy for that. And that's, in fact, not what really occurred. You can't say that 7 million families all were just a bunch of greedy people out to get a bigger house. I mean, something was going on, and I've already addressed that, so I'm not going to repeat it, but it has to do with the salesmanship and malfeasance in the lending process. And the more people understand that's what occurred, the less they're going to make a victim out of the homeowner who's trying to stay in their home, and the more they'll understand the situation. And I'll be glad to go on Squawk Box and talk to Kudlow about this.
Yeah, I think that sale is getting increasingly less difficult to make. I mean, I think, you know, it was just subprime, it was Alt-A, now prime loans, and it's not. It used to be in California, in Florida, and Arizona, Nevada, and Michigan, yeah, but it's now in every corner of the country. I take a look at the credit file data. We take a randomized sample of all the credit files in the country at the end of every month, and they're up everywhere. And it's not just cities; it's rural areas in Texas. It's coast to coast. So I think people understand that this is a broader issue.
You know, Bert, Curtis, just one little quick interjection. It is amazing the general unanimity, and I guess there are some outliers on this, that this is not a problem the market's going to correct on its own. I do not hear, and unless Kurt's about to do it, but as a person who I think tries to follow the debate and understand where the center of the debate is, there are not many people stepping up and saying, you know what? I mean, we've talked around the edges here about things that government is potentially making things worse through some of its procedures. But nobody is saying that the market left alone would cure this problem. Kurt, are you going to say that?
Not totally. But again, keep in mind this multiplicity of things. In the hot markets of Arizona, California, Nevada, Florida, et cetera, part of the general population was simply caught up. They weren't the greedy people you talked about, and I agree with that. But they wanted to buy a different house, and the prices were escalating so fast that they just caught up and didn't have any real choices other than to pay them. So that is part of the problem. Be careful when we draw conclusions about changing data. The Midwest and many parts of the country have not been having this problem to this point. It is beginning to show up there. Remember, that history then says that delinquency rates, foreclosure rates are very low. So when you want to come in and report that they're up 5%, 10%, 50%, remember you're starting from a low number. So they may still not be of any epidemic proportion. So again, be careful we don't lump everything into one situation here because it's simply a multiple-faceted problem.
I don't know if we have time for one more question. Do you want to do one more? Yes, ma'am. Wait, just wait for the microphone so everybody can hear you.
Hi, I'm Denise Leonard with the National Association of Mortgage Brokers. Mr. Taylor, you said that in order to solve the problem that we had to have responsible financial services, and yet you keep focusing solely on just the mortgages and minimize what's been said by the other individuals, that it's more complex than that, that there probably were people, and I know for sure, having done this for 19 years, that there were several people who were qualified at the time for those loans, have subsequently come back, and because of the excessive debt that they incurred subsequent to the mortgage, can no longer afford their loans. And yet it's been said over and over, and it still gets minimized that it was a product and it was a particular behavior.
Right. So they were borrowing against the equity on a mortgage that they already took out, that already had...
You know what, John? I'm going to cut that off. I'll tell you why. Because
okay.
I respect your question, and I think you made an excellent point, but I think arguing over the past is not getting us where we need to go, which is figuring what needs to be done in the future. So if there's one more question, anybody wants to take it, I have time for one more. Go ahead, sir.
I think the point that was made earlier about bankers being confused about all the government initiatives, I'm one of those bankers as well. But I started out in this town 20 years ago as a mortgage loan originator, and subprime loans then were FHA loans. And I think that we have an agency that has good programs out there that when at one point was 40% of the marketplace many years ago to 3% of the marketplace. I think what needs to happen in this housing industry today to get some of this inventory off of the for sale scenario is to really put more of those dollars into supporting the FHA programs. We're a new bank, like these two gentlemen, a good performing bank, but we can't get direct endorsement because FHA is so swamped in Atlanta that we have to send test cases in. So we have borrowers that want to borrow money from us, they're qualified, and we can't get the approvals from FHA in Atlanta because it's taking 6, 7, 8 weeks to get a case back. It comes back to us, and it's so nitpicked that they don't approve it, so these people go someplace else. So I think the government really needs to put some horsepower behind FHA and let good lenders...
We're going to leave this recorded portion of today's Housing Forum and return to the event live at the National Press Club. Coming up in just a moment, Representative Barney Frank, the